Hey folks, welcome to the latest episode of the What Does It Mean podcast. I'm Chris Versace. Joining me as always is my co-host Lindsey Bell. Lindsey, how we doing?
We're doing A-okay, hanging in there. How about you?
Hang it in there during a very anxious, nervous market. But, we're going to have a good conversation today, and we're actually bringing somebody in to chat with us a little bit about the market, but also more about the private market and the opportunities there. That's right. We're going to be talking today with EquityZen. Since 2013, the EquityZen marketplace has enabled the buying and selling of shares in private companies. And joining us, this is a good get, Lindsey. This is Atish Davda, co-founder and CEO of EquityZen. So I would say, folks, sit back and, Lindsey and I normally talk about what's going on in the public markets. I think you're going to be fascinated by the conversation we had with Atish and the private markets. Stay tuned. Lindsey, I got to tell you, it has been a wild ride in the market the last couple of days. And, I'm really happy that we've got Atish Davda, the co-founder and CEO of EquityZen, to kind of chew through the fat on the market with us, share his insights, because it's going to be a little different than ours, right? Atish and EquityZen, they're really steeped in the private markets, but I think we'll have a great conversation, kind of balancing our public market thoughts with what Atish has to say. So let's just kick it right off, Lindsey. What do you think about the market? Are we just simply, rebounding from deeply oversold levels, or is there something more going on?
Well, Chris, I think that based on market dynamics, it's very normal to get a bounce after very, very deep declines. So I think there's still going to continue to be volatility in the marketplace, but I also think it's a reminder that this is why we stay invested, because you can miss big bounces like what we're getting today, which we're taping this on Tuesday. Typically follow some of the biggest down days in the market, so you can't miss those, or your overall performance over the long term really can be impacted.
Totally agree. At the Pro Portfolio at the Street, we did not sell anything during the market sell-off last week. In fact, we actually picked up some shares earlier today in Marvell, ticker symbol MRVL. But Atish, so we see the public markets gyrating. You in EquityZen sitting there, really helping folks invest in the private sector, private companies. What's your take on all this? A lot of
Yeah, look,
noise, or?
look, you're absolutely right that private markets do behave differently than public markets do. Like what we see over at EquityZen is this: we facilitate trading in these private company names, and trading is a lot less frequent. It doesn't happen every millisecond. In fact, these trades, by definition, take multiple days in some cases to close, and so that's actually kind of an inherent positive that we see is people actually have a chance to digest the news. It's not just on the rumor that everyone's trading. They're trading after the rumor has been analyzed 5 ways from Sunday, confirmed. And candidly, from that standpoint, structurally, it actually does dampen a lot more of kind of the itchy trigger finger reactions that we began seeing starting last week, right? Starting Wednesday, even anticipating the big announcement of the Liberation Day tariffs, we just started to see a lot of market movement downward. Today it's nice to see the market be up a little bit, but, candidly, on the private market side, we see the public markets, a lot of the shareholders in the private markets are going to wait and see because they need to make multi-day, multi-week decisions in the first place. Look, the good news there is that they're going to have a bit of time to see where the dust settles before they need to pull the trigger on, whatever the new levels are that are going to settle down.
Right. Well, it's interesting, right? Because I do think even though we're bouncing today, Lindsey, you and I always talk about how it's important to play checkers. Sorry, I always mess this up. I always want to say chess, not checkers, but I say it the other way around. Let me just say it once and for all. Play chess, not checkers with the market. So kind of gaming out some moves ahead. And as we're sitting here, there are some, hurdles that the market has to climb over yet. The start of the Trump reciprocal tariffs, China's threatened retaliatory tariffs, Trump saying, hey, China, if you do this, I'm going to increase your tariffs. We don't know what the EU is going to do yet. And then corporate earnings. So, Lindsey, I guess my question to you is, how sustainable do you think this move is, or you think we're just going to be choppy?
I think we're gonna be choppy from here. There could be more downside, but I think it's gonna be up and down depending on the headlines. I think it's gonna be very headline driven, I guess, is what I would say. And Atish, I'm curious. I wonder if over the last couple weeks, especially last week, have you seen an inflow of cash or investors looking for these types of opportunities? Because I feel like investors, the sentiment is still very nervous among investors right now, and I wonder if they're looking for alternative opportunities. And I do would a private investment be considered maybe a more or less volatile investment for folks looking for safety and somewhere to hide in the near term?
Yeah, look, there's no doubt that private investments are, by definition, because you don't see kind of a ticker going by every second, you're just not going to have the same frequency of mark to market. Because of that and a bunch of other reasons, like the illiquidity premium that investors get, I do think private markets remain an attractive component of their portfolios. Over the last couple of weeks, what we've seen is two things. We've seen investors continue to invest in kind of the subsectors that are popular. So you think about AI, you think about cybersecurity, these sectors, then the enthusiasm behind them, they're not going anywhere. And the investors, deals that, like I said, sometimes take several weeks to close. Investors that had committed to those deals, they still, before they can actually kind of pull their capital, they said, no, in fact, we want to double down. If any other investors have dropped out, we want to take their allocation. Because again, they're making 10, 20-year bets in this case. They're not trying to buy on Tuesday and sell on Thursday. And so inherently, you have buy and hold dynamics coming in. Because of that, you have a lot of folks actually recognizing the buy side opportunity. And that brings me to the second dynamic that we've seen over the last, not just a couple of weeks, but the last really since mid-February, since the uncertainty in the markets really began to take hold, is that you see the supply curve coming in. You see the sellers come in and say, look, I may have, let's make this up, 100,000 shares in a high growth company that's maybe 2 or 3 years away from an IPO, trying to pursue an IPO. Maybe I'll take, 10% of the chips off the table. Now that I see the market coming back down, you say, okay, well, I'll still take 10% of the chips off the table. I still have 9 times more in the company. But why wouldn't I diversify a little bit? Maybe I actually want to go and buy in the public markets, or maybe I want to buy gold or whatever it is they want to diversify on. These are highly concentrated positions that a lot of the sell side of our marketplace sees. This is a quick reminder for the listeners that may not be familiar. What EquityZen does is we facilitate transactions between private shareholders of these high growth private companies that are typically 2 to 5 years away from an exit. And we match them up with high net worth individuals, family offices, and unsurprisingly, a lot of financial advisors who are recognizing that the vast majority of the American investor has an allocation of 0% to this asset class. And if you're only investing in public stocks, you're investing in an increasingly concentrated, increasingly volatile, fewer number of companies. And so we're helping a lot of these financial advisors grow the allocation for their portfolios from 0% to 1% to 2%. No one wants to put 10, 20% of their portfolio in here, but it really shouldn't be zero either. And that's effectively what our business does. And candidly, over the last 10 days in particular, unsurprisingly, we've had a lot of folks come and say, hey, are we seeing some real buy opportunities here because some sellers need the liquidity that they thought they were going to get from public markets, but it's going to be a bit harder for them.
Well, that
So
kind
when
of
you work with,
I was going to say that really kind of jives with some of the comments we've heard about like margin calls and other things. So not that surprising. But, just 2 questions. You mentioned IPOs, you mentioned exits and stuff. Just kind of help us understand, I think most people would think, oh, private companies, IPOs are the likely way
Yep.
for those investments to be monetized, but there's also M&A. Can you just talk to the breakdown, between the two?
Yeah, absolutely. And I'll actually throw in a third way as well. So you're absolutely right. The vast majority of these companies that we facilitate transactions in, these private market growth companies, they have backers. They have venture capital backers. They have private equity backers, growth equity backers, and they are incentivized in order to drive a big outcome, a big exit. So for that reason, typically these companies are positioning themselves to go public via an IPO or via a direct listing or via a SPAC, a merger. But there's more ways, exactly as you said. A lot of these private companies can exit via M&A. So you could have a larger private company, or in many cases, a public strategic investor come along and say, you know what? This is the piece of the puzzle we were missing. You might consider this happening, especially in a lot of we just saw this happen with Google with their massive $32 billion acquisition,
Whiz.
of a private company. Exactly. And so M&A doesn't have to mean a small exit. M&A can be a large exit, but it is absolutely an alternative to going public. And as I mentioned, there's a third way that private market investors can also get liquidity. Historically, EquityZen's about 13 years old. Prior to EquityZen offerings being available, what used to happen is that you would buy at call it year 5 of these private companies' life cycle. They're not really going public until they're teenagers, and so you're really buying for 10, 15, maybe even longer number of years. What EquityZen's begun offering is for a lot of folks saying, look, you can buy in year 0, but then you don't have to hold it for 15 years. These are buy and hold investments. These are illiquid. But if after 3, 4, 5 years, you are happy with your return, you want to recycle that capital elsewhere, you can actually just hit a button and relist that piece of private company stock for sale where someone else may come in. So I'll just give you an example. You have angel investors that invest in the early stages of the company. These are, folks investing with the company 0, 1 years of age, companies in its diapers. You have a public company that's graduated college. And the way we like to think about it is there's actually a tremendous amount of risk-adjusted return premium that's available just because people aren't aware that they can even access it. And so in these in-between years, high school years, college years, that's really where EquityZen likes to play in a company's life cycle. Someone's been invested in this company for 5 years, 0 to 5. We help find investors that want to hold it from 5 to 10 or 5 to 15 until the company eventually, exits. And, typically one of these 3 ways if it's a successful outcome.
I think that's really important because there are other companies out there, like, I don't know, WeFund or others that really work at that diaper age stage, as you say, and they'll take much smaller investments. You're working with companies that have already kind of proven their business model. So maybe if you could talk about the failure rate of some of the companies on your platform, one, but then number 2, talk a little bit about how you can invest, because it's not just, you don't do just direct share purchases. You build funds. And so I think it would be really helpful for listeners to understand how they can invest through you in these types of companies.
Yeah, absolutely. Thanks for asking that question. Look, you're absolutely right, and I like to think about a lot of these companies as athletes, right? Sure, you can bet on you can bet when someone's doing great at a toddler gymnastics class, just how great an athlete they're going to be in college and beyond. But really, when they're already in a competitive field in high school and college, that's really where we like to bring access available. And so yes, you have a bit more data to work with. A lot of the companies that we facilitate transactions in, usually at least $500 million or more in enterprise value, typically over $1 billion.
Wow.
Exactly to your point, Lindsey, these are not, power law, early stage VC investments where you're just hoping you're going to make 20 bets, spray and pray, and then you hope some of them, end up returning all the capital. No, we like to be very clear with our investors about this. We are bringing opportunities to hit singles, doubles, and triples. Right? If what you want is home runs, this asset class, or at least through EquityZen, is probably not the best opportunity for you. Now, if it's every now and then we'll end up getting 5x, 10x returns on an investment. That's great. That's not the goal. The goal is to very consistently get 2 or 3x or 4x your capital in 2 or 3 or 4 years. And that is what we, really put into our filters in order to figure out which companies are appropriate, which companies are not really suitable for our platform. And ultimately, we make it available to investors to say, okay, look, we will provide individual company access for you to build your own portfolio. Hopefully, you're doing it with a financial advisor that's able to, give you a small allocation of your portfolio so that you can, make some fun investments, something you can talk about on the golf course. But it's not just, it's not these meme coins and it's not these speculative assets like, buying wine or art. There's fundamental value here that we're bringing to the market. And now to answer your second question, what we realized when we were offering these individual companies is a lot of financial advisors were saying, Atish, this is great. Great access for the marquee names, the Stripes, the Databricks, the SpaceXs of the world. But you actually have a lot of value in, companies 10 through 50 that may not be household names, but actually might be great investments. But I can't tell one cybersecurity company from another. So do you have any options for us? And so what we began doing, Lindsey, is creating these basket funds. So now someone can come in with as little as $5,000 or as much as $5 million and put their capital into a basket, not just individual investment. And these baskets can give you access to a whole vintage over, call it a 12-month investment period, or into specific themes. We have these themes, AI fund or future or fintech fund or cybersecurity fund. And it's just a way for folks to say, I want to bet on the rising tide. I don't really want to make concentrated bets on individual boats here. And that's been unsurprisingly, a pretty popular product for folks, again, who are just entering the private markets.
And is the
Atish, sorry,
uh,
Lindsay, I was going to say, Atish, you had me at theme. But let me back us up just a second, because I'm kind of curious. You just said that, on the platform, you really have to screen out companies, right? To kind of, to use the analogy, separate the cream from the rest of the milk, right?
Yeah.
So what are some of the things that you look for in these companies? Because, different investors have different screening processes. And I'm just kind of curious as to what is it that makes the cut at EquityZen?
Yeah. Look, it's a great question. Let me just set the stage a little bit. There's over 12,000 companies that we track. There's about 500 companies that we have facilitated transactions in, and we sit on the cap table of. So we will actually, put together a special purpose vehicle with the company's blessing, get onto the cap table, have a share certificate issued, to an EquityZen managed fund. And again, that's a very small set of the over 10,000 companies that are available. And in fact, only 1 out of 20 opportunities that's listed actually gets to be available for purchase for the investor base in the platform. Why is that? Right? Again, it's because being a private company, you're not going to get access to the full sets of disclosures that you can for a typical public company. Right? A typical public company is required by function of being a registered firm to disclose all sorts of, contracts and financials and private information with the SEC. For private companies, that's not always the case. So what EquityZen does, we invest a lot of resources in this, is identifying all publicly available information about this private company and putting it together in one spot. By doing that, first of all, investors have the ability to understand, okay, what's the business model, who's the management, team, what's the cap table of this company, how much money has it raised, what's the liquidation preference, what's the waterfall in the event of $1 billion exit, $3 billion exit, $500 million exit. And so there's a ton of these kind of calculator type tools that folks can use in information that we compile. But some of the criteria that we look for, Chris, is one of the key ones is, has a marquee investor recently set a price on this company? And if so, for what shares, and what does that mean in terms of the waterfall valuation for other shares? So a typical company on our platform will have raised capital in just, recently, like less than 3 months, at most 6 months prior. In a lot of these cases, the incoming investor are large institutional investors because these are late stage companies. They don't need $10 million. They need $100 million. They need $500 million of capital or more. And so for companies like that, you actually have these marquee institutional investors that are coming in, pouring over the books. And what we like to, at least try to offer our investor base and our financial advisor base is education. This is not a public stock. This is not a liquid stock. This is not you buying Google shares on Monday with the ability to sell it on Thursday. And so you should really know what you're stepping into and what you're buying. And so by making a lot of this education available, what we find is financial advisors and clients alike, what they like to do is they say, look, as an individual, I'm never going to get as much of a deep analysis going as Sequoia, Benchmark, and Andreessen Horowitz will. And so if they've just valued this company less than 3 months ago, and based on that, I can invest potentially at a discount because of the illiquidity premium. Well, hey, that might be a bet that I'm willing to bet. And so a lot of times these are folks backing established backers that have very recently poured over the books and said, you know what, based on my institutional knowledge, $32 per share is the right price to pay. And then the individual sellers can decide, am I willing to sell at a discount, which many are, or is this the case where I can actually potentially sell at a premium? And the investors on the other side are putting in their own orders, and we just allow the market clearing price to take place with the company's blessing. Every single one of our transactions goes through the company. It's compliant with the company's transfer restrictions. And so in many ways, instead of thinking about this as a typical public company stock that you can just buy and sell, which is how simple we've made the process, what we're actually doing is every single one of these transactions is like a little mini IPO that we have just spent the last 12 years automating, standardizing, providing a blueprint to our investors saying, okay, right now we're in day 1 of the process. By day 30, your investment is going to close, and every step along the way, you have a variety of options to either invest more, invest less, make some different decisions. So it's an interesting avenue that at this point we have a little over 750,000 households on our platform. And we've done, again, over 45,000 private placement transactions at this place. And so over the last decade, we've just spent a lot of time trying to make what sounds inaccessible, not only providing the access, but also providing a bit more of the how-to guide, for a lot of folks.
So talk to me a little bit about dilution. Is dilution a big risk here, given how late stage these companies are? Or does it even matter because you're assuming that the valuation goes up significantly enough that it offsets any dilution?
Yeah, it's a good question. Look, first of all, it's important to call out that because these are secondary transactions that EquityZen facilitates, the transaction itself is a non-dilutive transaction. We are buying shares that are already been issued, and someone else is purchasing the same shares. The company's not issuing new shares in these cases. And so that it's a really important point. I just want to highlight that because the act of buying itself and others buying after you does not automatically make it a dilutive investment. But Lindsey, you're absolutely right. A lot of times our transactions will take place with the company expecting to go public in the next 12 months. And then guess what? The government announces tariffs, and all of a sudden the IPO window closes again for a few weeks or a few months, and the company has to kick the can down the road. Circle, which is a company that actually tried to go public back in 2022, right at the tail end of the big run-up that we had, and unfortunately ended up pulling its listing. And then just tried to go public again. And I think we're all hoping third time's a charm for them. But in effect, what could happen is a company that says, look, I think we're done with the last round of capital. They could, market dynamics can change, and they could end up raising a new round of capital, which would be dilutive. And it's important to call out that there's just no way, just like in public market investing, there's no way to really predict even what the best plans are that these private company management will lay out there is exactly how the company will go. What we do find, however, is that, again, because these are slightly more mature companies, they're not mature compared to Apple in a public sense, but they're way more mature. They have, they have actual executives with experience. They have a board that's ready to bring a company public in a lot of cases, or in the midst of that transition, compared to a lot of the earlier stage venture investing, which EquityZen does not touch. For this reason, is actually where the opportunity comes in. The example I like to always go back to, it was a big real light bulb moment for us back in the day. I'm going to date myself, but I'm going back about 8 years, 9 years. We had one of our investors, in one of our clients, tell us why they invested in Spotify. They made 2 or 3 investment in Spotify. This is back when Spotify was still a private company, and we had facilitated a bunch of transactions in them. And they said, I was at a barbecue, and my daughter and all of her friends, the only thing that they would use was Spotify to listen to music. And that really stuck with me, because more and more what we're seeing is that these apps we're using, whether on our phone or our devices, or just in day-to-day life, real innovation comes from these private companies. These are at the cutting edge of innovation. They're going to be private. And the typical company is, a teenager now. And if a company was going to go public at 13, guess what? The last 3 years means that they could easily be a 15-year-old by the time they go public. And so for this reason, it's really important for folks to really bring a buy and hold mentality, as opposed to I'm just going to invest in this name because it's what everyone's talking about. I would say the vast majority of the investors on our platform, really have a kind of a connection with the product of the company, and they've just been boxed out of the ability to participate in the value creation of the company. So what we're doing in many ways is allowing the fans of the company to give them just one more reason to talk about the company, and also allow them to participate in the journey as the company continues to mature.
Well, and that like dovetails with what you're seeing in the public market and the IPO market. We really haven't returned to IPO levels that we were at pre-pandemic. And the other thing too that you're noticing is that it's the larger companies. When larger companies go public, they're the ones that have the greater returns in the public market, at least say in the first year, rather than when the smaller companies go. So really there is that value generation in the private markets, which kind of makes the case for what you're doing. Maybe that's part of the reason that it's occurring, is because there is more access to capital. This way it gives the company more time to mature and prove out their business model and prove out their trajectory going forward. So that makes a lot of sense. You talked a lot about tech companies, which we're just totally in a tech wave, I think. And, the world is being
Yeah.
much more connected through technology. What other sectors or industries are you seeing on your platform really take advantage of the private markets?
Yeah, look, first of all, it's worth calling out that technology is just pervasive. It's pervasive. It's impacting all sectors. It's the same way that if we, I'm really going to date myself now. We used to call companies internet companies back in the day, right? And now there's no such thing as a non-internet company. I mean, there are, of course, but there's very few companies that don't have some internet presence, some commerce going through it. And so, Lindsey, I like to really think about a lot of private company sectors really as, yes, we call it technology, but it's agriculture technology, it's food technology, it's insurance technology, wealth technology, financial technology. AI, of course, is another one of these things that initially starts off as a vertical, but you realize this isn't a slice of the pie. It's actually a layer on the entire pizza, right? And I think that's what's going to happen more and more. And so, yes, technically, the way these companies would be classified initially would be technology companies, but it's not just software. I mean, we're talking about firms that are, building hardware in some cases, or again, when I said agricultural technology, we had firms, we've facilitated transactions in firms that have done genetically engineered seeds and, vertical farming, and that's just on the food side. And so I think to answer your question, I think it is way more pervasive. One key criteria that we look for, however, is a legitimate pursuit of an exit in a reasonable short time frame. And so,
Okay.
for example, a typical, private equity-backed firm that wants to remain private forever, that is not like Koch Industries is a private company. It's not one that would be suitable for transacting on EquityZen. And there's actually a lot of these private companies that are just perfectly fine and make sense for them to remain private. Bloomberg is another great company that will just remain private for the foreseeable future. Probably not a great fit for transacting on EquityZen. And so what we look for is this driver, this 10, 12-year fund life, this concept of I have an LP, I'm a GP, therefore as a GP, I'm a steward of the LP's capital. At some point I have to return it. And so it's really that driving force of seeking an exit that we look for. And as part of that, Lindsey, what we learn is, well, that does, that if you follow the money, a lot of the money does tend to go into technology. It does tend to go into, health tech or what have you. And so it's, I would say it's more of a correlation than a causal relationship. But one of the things, of course, that we do want is, because we're not making control transactions happen, we do want some forcing function for the company to eventually yield liquidity to even the people that are coming in at year 5. It's okay if it's not at year 10, 12, 13, but at some point there should be avenues for liquidity for them.
But Atish, what happens if a company continues past those teenage years, college years, let's say graduate school years,
Yeah.
right?
Move back into the basement.
Yeah. Well, yes, exactly. So what happens then? Because if it's not monetized, does it just continue to live on the platform as a private company that could be just a private company?
Yeah, so it's a good question. Look, I think this was not the key reason why, but a great use case for what we call express deals. This concept that I mentioned earlier, where even if the underlying investment has not exited, an individual's investment can still exit. And so we've allowed people to say, look, I really came in here to buy and hold for 5 or 6 years. I really believe in the stock. I wanted to capture it before the public market, kind of flooded in. But I'm happy with the return now. It's time for me to exit. Or, Chris, to your point, sometimes the company's plans of going public get delayed. In that case, the initial investor can hit a button again and say, I'm ready to let this investment mature for me, but someone else can come in and someone else, says, you know what, I actually want to hold this for a long time, because even if the company potentially starts issuing dividends, hey, that's something I'm interested in, and
Right.
it checks my boxes, but maybe, it checks Joe's boxes, but not Susan's boxes, and that's okay.
So it sounds like, though, that, if I want to get into a company or potentially get out of one,
Yeah.
it's not going to be a quick process, kind of like you said earlier, but it almost sounds as if a company moves into that graduate level, that the time to exit could be even longer.
It could be. Look, at the end of the day, these are illiquid investments. Here's what we do find. What we find is, in our 13 years of doing this, when we started, these transactions would take 6 months and you needed a minimum of $10 million to participate. And today, these transactions can take as little as 1 day, and you can invest at $5,000. Now, we like to think that EquityZen's played a big role in helping drive that. We're not the only ones, of course. A lot of traditional banks have come in and also helped kind of shine a light on it. BlackRock recently came out, Larry Fink came out and said, private markets need to be a component of everyone's model portfolio, right? So they've added it to their model portfolio. You have the large private equity firms doing this. I say all that to say this. I think what we've identified is what used to take months can now take days. And what used to require a very large kind of entry point, well, now it's a lot more accessible. The fundamental nature of these companies, just like any markets, has not changed, however. Meaning, if you really want to sell, there's probably a buyer out there. But that's where the word liquidity, it's not just about how quickly you can get your money out. It's how close to the most recent price can you get your money out. And I think just like what we're seeing with public markets, there's a lot of people today that say, oh, public markets are super liquid. Yeah, sure there are, but your $100 is worth 80 between Friday and Monday. And, I say that in jest as someone that has also been on the roller coaster ride with everyone else. But I just point out that, in that way, private markets are not that different than public markets. And liquidity is really a function, not just of how quickly you can get capital, but also how much you're willing to deviate from the most recent share price.
But I also think, though, that, you mentioned BlackRock just now, but there's other things that are happening that I think are shining the spotlight on this type of investing opportunity. And one of them is something that you guys recently did with Yahoo Finance. Can you talk a little bit about that?
Yeah, absolutely. And thank you for bringing that up. Look, our mission, EquityZen's mission from the very beginning, 13 years we've been building this, is to bring private markets to the public. And Yahoo Finance is a phenomenal property with over 100 million users every single month. And in the spirit of democratization, EquityZen, I think found a really great partner with a shared ethos where they want to empower the investor that's the early adopter, the early majority, the person that wants to put in the time, that actually has a bit of a passion for it, that does their own research, that actually thinks about it on nights and weekends. Well, that's wonderful. EquityZen, again, like I said, we have 750,000 households on our platform right now. And it was a very natural partnership between EquityZen and Yahoo Finance, because Yahoo Finance has begun offering private company pages now as a complement to their public company pages. And in one spot, they can allow Yahoo Finance users to construct portfolios, not just with public company stocks, which they've always been able to do, but also add in private company stocks. And this is information that EquityZen's, providing to Yahoo Finance for the benefit of not just Yahoo Finance users, but really the broader public. At the end of the day, our mission of bringing private markets to the public, it really kind of hinges on a few macro trends. Trend number one: companies are staying private longer. I think we're seeing this every single day. You said it earlier, there's fewer IPOs than there have been even pre-pandemic. We're actually at a 45, almost 50-year low in the number of publicly listed companies available. And so if you're investing in even if you're investing in the market, really you're investing in the Mag 7, driving most of the performance and therefore driving most of the volatility.
Yeah, I'm not so sure that's the case these days, but okay.
Well, so what we like to bring to the investors menu is, yes, you can invest in public companies, and there are many public companies. And if you're actually able to construct diversified portfolios, there's plenty of risk-adjusted returns to get, especially if you work with a financial advisor. Yeah, can people do this? Absolutely. Is it easy to do it? No. And I think that's the thing that I want to identify, is that right now, due to a lack of awareness, lack of historical accessibility, there is an illiquidity premium that's available. There's greater risk-adjusted returns that are available in this asset class. That's not the early stage venture investing. It's this pre-IPO investing. It's this investing in companies that are on a path towards IPO, not yet having gone public. And the partnership with Yahoo Finance really allowed us to bring the awareness of the category really to, again, just tens of millions of households, which we're very excited about.
All right. One last question, and then we'll get out of here. We kind of danced around it. We didn't really talk about it, but we're going to now, Atish. The IPO market is obviously very important to you guys.
Yeah.
We have seen CoreWeave recently went out, and there's some, I won't say issues with that, but the pricing wasn't really what everybody thought. We've seen a couple deals get pulled or at least postponed. Klarna, Chime, StubHub. So what are you guys watching to see that the market is not just going to open, but can be open kind of on a sustained basis?
Yeah. So you're spot on. Our business does have a correlation with IPOs out there. But if you think about it this way, as a middleman of private market trading, middlemen typically benefit from volatility, right? And so in the same way that it's true in public markets and private markets, here's what happens. If the public markets are going down and the IPO market, the IPO window is closing, the sellers, as I was saying earlier, come in and say, well, maybe I should take a few chips off the table rather than just holding everything for later. And so the price comes down, but the sellers come in. And if the IPO markets, the IPO window's open and the market's flying, the public market's flying, you have the demand side saying, you know what, there seems to be greater appetite for me to continue building on the momentum as the company goes public. So the demand side comes out. And so almost regardless of what the IPO dynamic is, either the sellers come down or the buyers come out. is what we've noticed historically. You're right about one thing in terms of IPOs. I'll actually expand it and say deal activity. Now, whether it's financing of a private company, it can be a up round, down round, sideways round. If there is attention on a company, if there is an investment going into the company, again, because these are institutional names, household names that are doing the diligence and writing big checks into these firms, um, a sideways round when the rest of the market is cratering is actually a positive sign. Look, I started my career in 2008, and I had this distinct memory of celebrating. I used to work at a quant hedge fund. I remember celebrating when we had a negative 5% return year. Sounds crazy, right?
Yeah.
It goes against everything I ever learned about high water marks and how hedge funds work, et cetera. But guess what? It was 2008, and the rest of the market was down 30%. And so because we were, systematic trading strategy and only delivered negative 5% return, we followed through on what we said we would do, which is give you uncorrelated systematic returns. And in many ways, private companies benefit from this because anytime you have an investment come into a private company, a professional, institutional, large check writer has done diligence. And by the way, they're fiduciary to their LPs, and that gives confidence to participants in the market saying, okay, I think I have a better idea of this being actually a fair value for my needs in this trade.
So thoughts on how and when the IPO market opens?
I think your guess is as good as mine.
Okay.
Look, I think the last 5 days of trading have been, if there's anything they've taught us, is this. In the last 25 years, the S&P has had 14 intra-year drawdowns of 10% or more.
Yep.
These things are more common than we like to believe. And as long as we can, hold the ship steady, I think most of us will be all right. I don't know when the IPO market will open, but I'll tell you this: we are eagerly awaiting just a calm in the market, let alone kind of the IPO window cracking open, because I think one will follow the other.
Well, I think that gets back to Lindsey's opening comment: time in the market.
Mm-hmm.
Yeah. So, all right. Well, thanks, Atish. We really appreciate you stopping by and chatting with us on this. Perhaps when the IPO market, opens up, extends, and some of these private deals are going public, we can revisit with you.
That sounds great. Thanks for having me, everyone.
Thanks,
Awesome.
Atish.
Thanks, Atish. Wow, I got to tell you, Lindsey, that was a different kind of conversation with us. I mean, really drilling into something that I have to be honest, I pay attention to private companies in so much as what's queuing up for the investment banks and IPOs. But I think the conversation really threw a light on some of the opportunities that are there that perhaps everyday investors need to contemplate.
Yeah, no, I think it was really very interesting because there's a couple different companies that do this, and I sort of mentioned it that you can invest in private companies for very small amounts nowadays, depending on which marketplace organization you're using. But I found the EquityZen approach really interesting because they really do their homework and they're looking for companies that are, what did he call them, teenagers, right? They're not these
Right.
like seed level, like year one, year two, just getting started out and looking for money so that they can grow. So they really have a proven business model and they're close to exiting. And that's another like key characteristic that they look for on the equities end side is companies that are, he said 2 to 3 years from an IPO or whatever type of exit. So they kind of do the homework for you before you get on. And I'm not trying to do a sales pitch here, but it's just an interesting differentiated way to maybe diversify your portfolio, right?
Yeah, I think you're right. What stood out to me was, and I wasn't aware of this, we were heading into the conversation, but the basket-like approach that they can offer to folks as well, right? So, like, from a thematic perspective, if I want, I think Atish talked about cybersecurity or AI, those are some obvious ones, but there might be some other
Yeah.
baskets in there that, boy, I'm reading a lot about this. I want some exposure to it, but I don't want to take the risk on any one company. And I think that really is a novel approach, in my opinion, and it's one that gives you all the benefits with a lot less risk.
No, it's totally true. It kind of, there are names out there that just aren't as mainstream as some of the other ones that are more likely to get more money because everybody knows who they are. And so this gives those companies the opportunity, and it helps them innovate and us become a better, stronger, technologically advanced economy, I guess, right?
It gives us a lot more companies to talk about, that's for sure. So, all right. Well, any closing thoughts, Lindsay, before we get out of here?
No, just a very interesting conversation and nice to take a break from talking about tariffs and volatility.
Well said, Lindsay. Well said. Well, by the way, I get an extra break because I won't be here next week. You are going to be chatting with our good friend JD Durkin next week, and I'm sure you guys can have a great conversation. I'm hoping that he brings his political insights to the conversation. So maybe he'll be talking a lot more about tariffs, Lindsay.
Yeah, it's gonna be a good one for sure. So tune in next week. We'll miss you, but JD is awesome.
He is awesome, and I will be back before too long. Don't you worry. Folks, between now and then, if you need to get a hold of Lindsay, need to look at anything that she's thinking about, sharing your insights, Clearonomics and LinkedIn are the place to be. For me, march on over to the Street Pro portfolio. I'll see you there. Thanks for listening.